All right, why don't we get started? Becky told me once we passed the magic 100 attendee mark, I could kick this off. So I'd like to welcome everyone to our presentation, Straight Talk on 409A Valuations. We call it Getting It Right the First Time. I'm Gary Levine, the CEO and founder of Corporate Focus, and we're hosting this presentation today since we know that many of the CFOs that eventually use our system, Corporate Focus, for their equity administration, accounting, and reporting struggle with Section 409A compliance since it can be costly and takes some effort, but at the same time the consequences of noncompliance are very painful. There are tax consequences to employees and potential financial reporting consequences to the company. Also, we know for some companies, Section 409A compliance and common stock valuation related to their stock option grants can be an issue that needs to be dealt with prior to the time when a company needs to report their equity compensation expense or even have their first audit. So it's something that often comes up a little earlier than people actually expect. We hope this presentation will help companies get it right the first time and a little earlier in their life cycle so they can avoid the time, cost, and embarrassment of not getting it right. Before we get started with the presentation and by way of introduction, for those of you who don't know our system, Corporate Focus, which looks like this, it's the leading cloud-based equity reporting system for privately held emerging growth companies. It's used to track the equity records for tens of thousands of privately held companies, and we've been doing this since 1995. We work with CFOs as well as legal and finance service providers that are ready to move away from spreadsheets for stock option tracking, compliance, and reporting. The presentation will last about 30 minutes, and a recorded version will be made available to all participants after the presentation in case you want to share it with somebody who wasn't able to make it today. As noted here, since there's many people on the line today, all of your lines are muted during the presentation. The panelists will be answering questions at the end. Please submit your questions using the little chat window in the right-hand corner of your GoToMeeting window. There's a section that's labeled Questions. If you open that, type your question, and press Submit, you can submit it privately so it doesn't go out to everyone who's on the line today. We'll look through the questions we get, and before the end, we'll sort through them and choose those that we have time for. But for those of you who have questions, whether you have them right now or halfway through, please don't wait till the end because we do need to have a few minutes to get through them. So if you want us to have a better chance of getting to your question, please submit it a little bit earlier if possible. As far as a little preview of what we'll be generally covering today, this presentation is geared to those people who have not had a 409A valuation yet and want to learn why you might need to get one, when you should do it, how difficult it is to do, what you will have to do or perhaps provide to some of the people who are on the line today, and what considerations you can think about in advance to avoid some problems down the road. As far as our presenters today, we have three expert panelists who will be presenting to you from three different perspectives. They will each speak for 5 or 10 minutes, and then we'll answer questions, as I mentioned. I'll introduce them in the order that they'll be speaking. First is Dave Broadwin, who's a corporate partner at the law firm of Foley Hoag. He works in their Boston office, heads their Emerging Enterprise Center, and focuses on representation of venture-financed technology companies, as well as buyers and sellers of public and private companies. After Dave, Channing Hamlet will be speaking, and he's a managing director at Cabrillo Advisors, based in San Diego, and has managed hundreds of business valuations and fairness opinions throughout his career. Cabrillo is one of the leading 409A valuation firms in the country, and they work closely with the clients of many leading law firms, VC firms, and audit firms. And third, Ed Sullivan will be speaking, who's an audit partner at KPMG. He started with the firm in 1985 and is currently working out of their Boston office. He works primarily with clients in technology industries and leads audit teams in the conduct of auditing client financial statements, as well as advising clients on various business accounting and financial reporting matters. And we're very pleased to have all of our panelists today. With that introduction, let me turn the first part of our presentation over to Dave Broadwin.
Hi, this is Dave Broadwin, and thank you for the introduction. I should just say by way of preface that my law practice focuses to a large extent on early-stage companies that are either financed or could be financed by venture capitalists. And 409A is something that comes up in each and every instance, mostly in this context, in the context of option grants. But to begin with, it seems like the first question is, what is 409A? Well, 409A is a section of the Internal Revenue Code that governs deferred compensation arrangements, of which options are a subset. So don't think of 409A as just an option problem. It could come up and does come up in other contexts, particularly employment arrangements where there's some sort of severance. So what is deferred compensation? Deferred compensation is something that has a sort of a technical definition, and it really means a legally binding right to compensation that arises in one taxable year and is to be paid in a later taxable year. In other words, the compensation is deferred to some future point. Options, as I said, are a subset of deferred compensation. From the IRS's perspective, deferred compensation is typically broadly defined, and you should sort of be aware that it may include many items that are not traditionally considered deferred compensation. For example, severance payments, bonus payments could be deferred compensation, and equity incentives. Obviously, options will be a little bit of a focus here, but stock appreciation rights can also fit that description. Next slide. So why do we care? Well, we care because there are some pretty negative consequences to the recipients of non-compliant deferred compensation. And some of them are here on the slide that I've got up. The most important one is you get to include the deferred compensation in current income, and you pay a 20% penalty tax over and above your regular income tax. And note that it says, at the time the right vests. So that's really bad for a variety of reasons, mostly because you don't have, well, nobody wants to pay the 20%, but in addition, because it's a deferred payment, you have the payment in, the income in the current year and the deferral, meaning the cash in some future year. So these problems are particularly exacerbated for options. If you have non-compliant options, you get income at the time of the vesting of the option, whether or not the option is exercised and whether or not there's a sale of the underlying stock. So you get the 20% penalty, and in addition, there's a similar tax penalty each year as options increase in value. There's some special rules that govern public companies. I'm not going to focus on those, but I think it's worth at least mentioning that payment of deferred compensation to public companies, to so-called key executives of public companies, due to separation of service, has to have a delay of at least 6 months in order to be compliant. Next slide. So how do you get around this? Well, there are a number of ways to get around it. With respect to deferred compensation payments, there's the so-called short-term deferral rule. There are payments that meet the 2 times and 2-year rule. And then there's a whole bunch of rules that relate to the to when you can issue options and what is a compliant option. I should note that incentive stock options, as well as statutory stock options and stock appreciation rights can be compliant if they meet all the relevant rules, which I'm about to go into. But let's start with the short-term deferral rule. Can you move to the next slide? The short-term deferral rule. This is what the short-term deferral rule actually says. You're exempt from the 409A penalty if payments are made no later than 2.5 months after, whichever is later, the employee's or the employer's taxable year in which the right to deferred compensation vests. Now, vests means it's no longer subject to a substantial risk of forfeiture. Keep in mind that a substantial risk of forfeiture means that you might not actually get the payment. And this has a fairly narrow definition for 409A purposes. For example, a non-competition provision does not create, that is to say, will not create a substantial risk of forfeiture. Payments made upon certain, sort of good reason terminations. You may be familiar with the notion that people can quit for good reason, and good reasons often defined in employment contracts as, a diminution in salary, diminution in position, and so forth, may or may not be deemed subject to substantial risk of forfeiture. So you need to think of substantial risk of forfeiture as a fairly narrow exception. So let's move to the next slide and talk about the 2 times and 2 year rule. The 2 times and 2 year rule exempts certain payments in cases of involuntary termination. And I stress the notion of involuntary termination because this clearly does not apply to voluntary termination. So if you're going to get a payment, a deferred payment, and you can capture that payment, if you will, by voluntarily quitting, that will not get you out of 409A. It must be an involuntary termination. In addition, the payment must be less than the lesser of either A, twice your annual compensation, or B, 2 times the IRS limit for these types of payments. The current limit, I believe, is $245,000, so 2 times that limit would be $490,000, but that may have been adjusted upward in recent years. So that's the, and it's got to be paid within 2 years of termination. I should also note that if a payment exceeds these limits, you can be exempt up to the limit, but the amount in excess of these limits will be subject to the penalty. Let's move on to talking about options on the next slide. So the previous 2 slides really talked about severance-type payments, what happens when somebody leaves and they're owed a payment. The more common issue, and the one that we come up against all the time representing early-stage companies, is what to do about options. How do you price them? What's a qualified option? And so these bullet points really set forth what are the requirements for a qualified option, qualified in the sense that it's compliant with 409A requirements. And I'm just going to go through them quickly. The option must be for common stock. That is to say, it can't be for preferred stock or for some other security. And that's typical of option plans, of course. The stock must be issued by the service recipient. That is to say, the option grant must be from the company to whom the services are being provided by the employee. So you can't get options from an unrelated business to do work for your company. That would not qualify as, that would not be a compliant option under 409A. And here's the big one. It must have an exercise price not less than the fair market value on the date of grant. And I've put that in bold on the slide because that's the issue that really comes up and is hardest to address. These other issues obviously are pretty clear. I mean, it's always common stock, it's always service company. And I'm going to jump forward now and talk about the fixed number of shares. It's always a fixed number of shares. Well, not always, but almost always a fixed number of shares. There's almost always, well, there will always be, as a practical matter, a taxable event when the options are exercised and so forth. So the real issue that arises is, how do you value, what's the fair market value of an option for a privately held company for which there's no market, and the only stock that's been sold in a arm's length transaction is preferred stock to venture-style investors. Let's move on to the next slide. So this is the issue, and I suspect some of the other speakers here, Channing Hamlet in particular, will be talking about pricing option grants. So if you issue options at less than fair market value, with an exercise price of less than fair market value, all the bad tax consequences that we discussed before arise. There's a 20% penalty, there's the penalty on increases in value, and so forth. However, 409A provides a number of ways that you can actually safely price options. My first one here, of course, guess, is a little bit tongue-in-cheek. This is when the bad stuff happens. Somebody says, well, okay, I'm issuing options at a penny a share, even though I just sold stock to a Series A stock to a venture capitalist at $5 a share, more likely $1 a share. But we think of common stocks really only worth a penny. Well, you're guessing, and if you guess wrong, the IRS can come back and capture all the tax, including the penalty that we've discussed. So there are two other principal ways in which you can eliminate this uncertainty. One is commonly done for early stage companies, and that's internal valuation by a sophisticated person, which can be a member of the board of directors. These types of valuations have to be in writing, and they have to follow a reasonable methodology, and they have to be consistent, and they have to be within 12 months of the date of the option grant. So that will work up to a point, and some companies do that. The far more common thing to do in my experience, and I would say that something north of 90% of my clients do, is they pay an outside firm to do a valuation. And so long as the outside firm follows, similar methodology, the same methodologies or appropriate methodologies, then, you will get the safe harbor for 409A option grants. And is that my last slide, or do I have another one after this?
That's it, Dave.
That's it. Okay, so I guess in closing, I just want to make the following overarching comment. I'm not aware myself of the IRS ever actually, quote, going after, close quote, anybody in the venture financed company context for 409A penalties. But it is certainly possible. There are, as I think we'll talk about later, negative consequences not just to the employee, which is what I've focused on, but also to the company for this. And in any event, it's something that investors focus on very closely. So it is very common that once you get past some very, very early stage, that people will go out and retain valuation firms to do valuations, and that they will update them from time to time, either because of the passage of time. So if more than 12 months has passed from the time that you've had a valuation, you may look at another one, or because there's been some intervening event. Perhaps a milestone's been reached. Perhaps there's a new financing at a new price in an arm's length transaction. Perhaps there have been arm's length transactions in the common stock, all of which can impact what is the fair market value of common stock underlying an option. So that's the basic background.
All right, great. Thank you, Dave. With that, Let me turn the presentation over now to Channing Hamlet, who will give us the valuation service provider perspective. Go ahead, Channing.
Yeah, so Gary asked me to talk about kind of the valuation process overview, and then a little bit about how the process works when we work with a company, and then I'll finish up with some thoughts and observations I have on pitfalls and common mistakes and things like that. I guess the first thing is the AICPA created a task force when 409A initially came out to provide pretty specific guidance on appropriate methodologies and approaches, which is what most firms that do, and our firm follows when we do 409A. Another common question that I get is, how often do we need to do it? And Dave alluded to it, and typically it's every 12 months, and then sooner if there's been a material change in the business that would imply that the valuation of the company changed. And material events are things like financings, key kind of news items or milestones being met, and then at some level it's kind of it when you see it. And generally speaking, the valuation also follows to be compliant with the IRS. There's a number of factors that need to be considered beyond just kind of company-specific factors, and the IRS asks valuation professionals to look at internal and external factors that are on the slide, but basically what's going on in the economic environment, the industry, the competitive environment, et cetera, and then internal factors in terms of what's going on in the company. Many of these are challenging in our client base because the vast majority of our client base is venture capital backed, and many of the companies are kind of going after new markets or trying to disrupt the market or something like that. So sometimes it takes some pretty creative and clever research to really be sure we're covering all our bases and in producing an IRS compliant report. Next slide, please. Generally speaking, I thought it might be helpful for the group just to understand at a high level the process to do the valuation. And it's really a three-step process. The first step is to come up with a value of the business as a whole. The second step would be when companies have multiple classes of stock, doing an allocation of the value among the classes of stock. Most of you would agree that preferred stock with its preferences and special terms would be worth more than common. And then the third step is to look at various discounts that the IRS allows and agrees with in terms of control and marketability. In terms of the first step, I think anybody who's been exposed to valuation will recognize the basic approaches here. The first one that I've got is a market approach, where we would look at both publicly traded companies as well as come through databases of private transactions to understand multiples that were paid and prices were paid for either shares of publicly traded stock in the case of public companies or for M&A transactions, and try to find companies that are similar in terms of business model, sector, stage of development, et cetera, in order to get an indication of value. As companies get more mature, the market approach becomes more and more relevant. It can be hard to apply for early stage companies. The second approach is a income approach or a discounted cash flow analysis. And effectively that would be working with the company to develop a set of cash flow projections and then pick an appropriate discount or hurdle rate and calculate the net present value of cash flows. Again, that can be challenging for very early stage companies where the projections are somewhat speculative, and it becomes a lot easier to apply as companies get more mature and the projections, you can look at the past to understand future projections. The third approach that frequently gets used is an asset approach where we might separately identify the value of both tangible and intangible assets in a company's balance sheet and look at that. I think Generally speaking, my impression from working with our clients is that the step one is relatively simple for people to wrap their minds around, and it's step two, and you can go to the next slide. It's step two where it requires a little bit more discussion and education typically. And my observation is most venture rounds get done using this kind of pre-money and post-money concept where the company raises $5 million at a $10 million pre-money, and that means that the venture capital firm owns a third of the upside, and the founders would keep 2/3 of the upside, et cetera. And I really view that discussion for early stage companies not necessarily as a discussion about what the company is worth. It's really more a discussion about who gets what when the company is successful. And so there's some methods that the IRS and the AICPA ask us to consider when we're figuring out the value difference between the preferred and the common stock. I think the most common method that is being used for companies that have raised a Series A or a Series B financing where they're not quite close enough to an exit event is the option pricing method. And it's effectively based on some Black-Scholes modeling where you look at the breakpoints in the cap table to understand the value of the company. And effectively, the way I think about it is if you own a share of common stock in a venture capital-backed company where you have preferred stock ahead of you, if you think about it economically, that'll behave very similar to an option. It will, if the value of the company appreciates meaningfully, it'll be worth something. If the value of the company kind of stays the same or goes down, it'll be worth nothing. And that's exactly the same as owning an option for a publicly traded stock. And so that's why the option pricing method is sort of theoretically applicable in this case. The other two methods that I've got listed on this page are used, but used less frequently. The probability-weighted expected return method effectively is a fancy word for scenario analysis. And typically, we're going to switch to that when an exit in a company is more imminent, and you can define more discrete probabilities of events. So typically, when a company is either in the S1 process or interviewing investment bankers to go public, or they're interviewing investment bankers or preparing to sell the company, and you can start to work with management to define specific percentages of these possible outcomes. We'll switch to a probability-weighted method where you say there's a X% chance we're going to go public, there's a Y% chance we're going to sell, there's a Z% chance that we're going to go out of business, and then there's another probability of we just keep doing things the way we're doing them. And then the final method is the current value method, and effectively that's used much less frequently and usually for very early stage companies. Next slide, please. The third one, there are some discounts that can be applied, and this is where there's, in all honesty, some judgment and subjectivity. But effectively, if you're granted options, or if a company is granting options that represent less than a controlling interest in a company, the IRS, in its literature, accepts a discount for lack of control. And then if you're granted securities in a private company, those are also not readily marketable, and so it's appropriate to use a discount for lack of marketability. And in both of those discounts, there's a number of subjective factors that a valuation expert can look at, and some analytical models that can be applied to develop appropriate discounts. Next slide, please. In terms of the information requirements, I won't spend a lot of time on this because I think it's pretty straightforward, but generally speaking, your valuation expert's going to want to look at historical and projected financial statements. Many of our clients that are earlier stage, where they've raised a Series A or Series B financing and they're still kind of in product development, don't have great financial projections, and so typically we can work around that or work with the company to develop one or more scenarios. The second area that we spend quite a bit of time on is understanding the capital structure and ownership of the company, as well as the terms of all of the securities that are outstanding, both preferred stock and common stock, as well as debt and convertible debt. The third area that we spend time is getting an understanding of the business. It's great when companies have well-written business plans. Not all companies do, and so there's an interview process that takes place to understand the business, the risks and the opportunities, what's going on in the market and the competitive landscape, et cetera. And then there's a final piece of information that is absolutely critical, and that is getting a very good history of all the transactions that have taken place in the company's securities. So if there have been prior transactions involving any of the securities, particularly common stock, it's important to understand that. And then full disclosure around pending transactions. One of the things that I spend quite a bit of time thinking about when I work with clients is, I'm doing a valuation today, and it's based on all the information that was known or knowable at the time. The purpose for the valuation for IRS purposes is if the IRS ever comes and knocks on your door and is asking questions about it, they're going to have the benefit of hindsight. And so even though the valuation is supposed to be on information that was known or knowable as of the date, in the future there's going to be hindsight available. And so if it's likely that there's a pending transaction, it's important to disclose that to your valuation expert so that it can be factored in and you don't wind up valuing the stock at $1 today and then 2 months later selling it for $10. I think that would, if the events are close enough in time and an IRS agent has the benefit of hindsight, or the SEC or whoever's reviewing the valuation, that could call things into question. So being really forthright and open around pending transactions is important. Next slide, please. Observations and pitfalls. I think the biggest observation I have, and our firm's been doing this 409A valuation for 5 years now, and before 409A came out, I think the rule of thumb was to take the preferred stock and divide by 8 or divide by 10, and in different geographies there were sort of different rules of thumb, so to speak. Those methods have really kind of gone out the window, and what we're seeing increasingly with the guidance, et cetera, and the techniques are that it's really hard to get the math to work and come up with a supportable answer where you're winding up with the common stock at 10% of the preferred. And so as companies are getting more mature and they're raising valuations at higher and higher, raising rounds at higher and higher valuations, the stock price as a percentage of preferred is starting to, creeping up over time, and there should be a kind of an expectation of that. There's a couple reasons why, from a valuation perspective, I see 409A as being really important. And you have to kind of consider all of the different audiences that are going to use your valuation. The first one is the IRS, which I've already talked about. Your CPA firm, or when you're starting to do your first audit and you need to do your stock compensation expense calculations, which dovetail quite well into corporate focus and what they do. You need a common stock value that serves as an input for that calculation. Then the final two are, in an exit transaction, an acquirer is going to ask your company to represent and warranty that you're in compliance with tax regulations, which include 409A, and they'll frequently review the valuation work that was done and make sure they're comfortable with it. And if you want to go public, it's an area that the SEC scrutinizes quite heavily, and so the valuation needs to be done considering all of the different constituencies. The final point I would have on the on the pitfalls is it's even though the company's early stage and it may seem like a nuisance to have to do all this valuation work, it's absolutely critical, because once you've issued options and the company is appreciated, it's very hard, if not impossible, to go back and correct mistakes that were made, and they have significant consequences to both the company and to the employees. And so getting the option program wrong or getting a valuation wrong is a big deal in terms of tax consequences for employees, morale, et cetera. So, really be careful in hiring the valuation expert and make sure that, on the company side, you're putting the appropriate, diligence and review processes in place. And I think that's the end of my slides.
All right, great. Thank you, Channing. That was great. Now let me turn it over to Ed Sullivan for the auditor's perspective. Go ahead, Ed.
Thank you very much, Gary. I guess I should start by saying, similar to Dave and Channing, a very significant portion of my practice focuses on early-stage companies, all technology. I'm actually the partner that is in charge of our venture-funded company practice here in Boston, and sort of the founder of our new office in Kendall Square. So I see 409A very, very often, and unfortunately, I generally see it at the end and not the beginning. So what I wanted to do is just cover some key questions that would give you sort of the auditor's perspective of 409A. And the first, and Channing touched a little bit upon it, is, why is this topic relevant to your auditor? 409A, generally, the evaluations sort of protect the individuals, but from a company perspective, when we are auditing a set of financial statements, we're auditing all the accounts on the balance sheet and the accounts on the income statement, and stock compensation is an account like any other account. And in many situations, the fair value of the grants that you've given and that are being expensed are a reasonably significant number in the income statement. So as auditors, we need to audit those valuations. And that's really for, let's say the early stage pre-IPO companies where that's the main focus. But once you start talking about doing an IPO, we then become even more focused on it, because for a period of time up to your IPO, the SEC is going to ask you to support the values of your options for a period of time up to the offering date, or the time you decided you were going to go public, and when your underwriters sort of gave you that first indication of value. And we've seen many IPOs get held up because the company couldn't support, let's say, a $1 value of its options when it was going out at $16 a share. It held up the deal, and then ended up the company having to go back and restate prior year financial statements. So it became an expensive exercise. So as auditors, we like to get in front of this issue early. When we're doing audits, it's generally the area that we spend the most time on, because it's the most significant judgment, and it can vary greatly. Channing also touched upon sort of the most common myth, or the rule of thumb, sort of the 10-to-1 ratio, or the 1-to-10 ratio, depending on how you look at it, was something that was very popular back in the late 90s, and there were some investment bankers and law firms that sort of built a database of pricing that everyone relied upon. But the SEC, long ago gave up on accepting that theory and wanting to see actual valuations. A couple of things you need to keep in mind when you talk about the valuations. When you think about your investors, they're not always all that concerned about the value of options, but somewhere down the road, some regulator, if you're fortunate enough to be successful in your company, some regulator may really care about that pricing, and it's hard to balance the interest of those two parties. The next question is, when should I have a valuation performed and how often? And 409A aside, in terms of protecting the individuals, but from a financial statement perspective, should you be having valuations of your options done, when you're pre-revenue, or should you wait till you're post-revenue? Do I need to have them performed annually or quarterly or even more frequently? Or do I need to have them done in conjunction with a round of investment or financing? And I'm going to say there's really no specific answer to these questions. It's all based on the facts and circumstances you're dealing with in terms of how many options are you issuing? What's the relative value? So from an audit perspective, if I can look and see that the number of options you've granted are not very high, and the value is not very high, and with respect to the financial statements, it's not a very big number, for audit purposes, I may just move on and say it's just too small to care about. The following year may become a bigger number and we start spending more time on it. But I think it depends upon the facts and circumstances of what you've issued, how close that issuance was to, let's say, a third-party round, a VC round, how close was it to your company signing, let's say, a very significant revenue contract, a big deal with a customer. We've actually worked with clients in the past, and this is quite a ways back, but a company that was spinning out startups seemed like almost every quarter, and they were having valuations done of those subsidiaries every quarter to support the price of the shares, so that when they did spin them out public, they didn't have any issues. Next page, please, Gary. When should who should I hire to perform the valuation? So you've heard from Channing, and Channing works for what I would characterize as sort of a smaller firm as opposed to a large firm. Large firms like KPMG, PricewaterhouseCoopers, D&T, Ernst & Young are very large firms. They all have valuation departments. They all do this sort of work. There are firms like Channing's, and then it goes all the way down the spectrum to a guy with a computer who's got an Excel model. And when you think about the work product that comes out of those sources, generally, the reliability of the work product varies depending on I hate to say it, sometimes what you paid. So this is one situation where the phrase "you got what you pay for" tends to be generally true. So when you look at who you're going to hire, it's good to know who that firm is, what other clients they've worked with. If you have aspirations of going public at some point in time, it's good to ask that firm or that individual, what other accounting firms have you worked with in terms of, you've done valuations of companies. Have any of the bigger accounting firms reviewed your work? Did the valuation, stand up to their scrutiny? All good questions. The other question is, when should I get my auditor involved? And this, like the last question, and entrepreneurs in early-stage companies, really comes down to a cost question. You're trying to reserve all of your resources to work on your business model. You really don't want to spend dollars on a valuation report or, frankly, on an auditor either until you absolutely have to. But this is a situation where you can take let's say, the inexpensive route and not have an auditor involved until the report is final, and you run the risk of the auditor looking at it and saying, this model's not appropriate, these assumptions aren't appropriate, so you end up having to go back and redo the valuation. Or you could be on the other end of the spectrum, which frankly is where I like to be, is I like to be brought in sort of in the initial planning phase. And we often will spend a couple of hours with you and or your valuation firm just discussing the approach, how you're going to do it, what are the major assumptions, without billing for that time, so that we know then when we come in to do your audit work, there's an expectation that what's been done is really already in sync with what we would have already expected to see, and it will take us less time to audit it. So that's really, when. And then you also got to think about the impact of changing your valuation. impact from, board approvals. The board approved the option price a year ago at $1, and now your valuation firm and/or your auditor is saying, well, gee, that value really should have been $4. And then you also got to think about in terms of completion of your financial statement audits. The valuation of the stock and the Black-Scholes model is something we like to do very early, as soon as it's ready for us, so that when we're trying to wrap up an audit, this valuation issue doesn't hold us up and get people disappointed with the delivery of the financial statements. So those are really the questions I wanted to cover. So Gary, that was all I had.
Okay, great. Thank you, Ed. And thanks to everyone. That really wraps up our formal part of the presentation from our three panelists who provided their thoughts on Section 409A and, as we say, how to get it right the first time, since it makes it so much easier if you do, as opposed to trying to play clean up down the road. So with that, I'd like to turn to some of the questions we've received. But before we do, I'd like to just thank everyone who's attended in case some of you need to leave during the Q&A. I will note for the benefit of our panelists and those on the line that less than 1% of the attendees have left, and that 99% of the people, according to my screen here, have kept this this presentation on the top of their computer during the presentation. So apparently this is an area of great interest, and people have really paid attention. We have about 5 or 10 minutes left, so we'll take that time to answer some questions. And I'll just mention again, we will send out an email with a link to the recorded presentation probably tomorrow, and we'll also let you all, people who attended, know as soon as a copy of the slides have been posted somewhere online with a link to the slides, just so people know that. But in terms of jumping to some of our questions, I have a longer list here, and we'll just take a few of them for time purposes and try to address those that are a little more generally applicable and see how that does for time purposes, and otherwise get into a few that are more unique or specific. The first question that I'll throw out to Channing, and Dave and Ed can join in. Let me just open their lines. Is, of course, someone asked, what does the average 409A valuation cost, or can you give us a little bit of a range? So I know you started to talk about that, Ed, but let me jump to you, Channing. I'm sure you get that question a lot.
Yeah, and I guess the answer is it depends. It depends. If I go back to my discussion, there's several steps in the process, so it depends both on the complexity of the business as well as the complexity of the cap table and the terms. And then the other thing our firm factors in is the number of updates that we expect from the client, because there's kind of an economy, there's economy of scale of getting to know the company and doing more frequent updates. So we sort of work all of those factors in. And I would say that the pricing for pretty early stages is starting in and around the $5,000 range, and it goes up from there as companies start having traction and the cap table starts to become more complex.
Okay, and any other thoughts on that from either Ed or Dave, that you've seen anything different, obviously in your experience working with other valuation firms, just to give people on the line a sense of what you've seen in terms of cost of these valuations?
This is Dave. I would say that $5,000 is a very good price. You can't, here in the Boston area, you can go lower, but you would absolutely be running into some of the issues that Ed Sullivan has pointed out. You'd be going with a sort of solo type person, and then there might be questions later on about the quality, if you will, of the valuation. I think pricing in the Boston area might be a little higher than in the San Diego area. I think we commonly see sort of $7,000 to $8,000 in my client base.
Yeah,
and that's for an initial valuation. Then there's a much reduced price for what we refer to as bring downs. So there'd be sort of an annual bring down, and that might be, you know, 2,000, 3,000, some number like that.
Yeah, I mean, I guess the thing I would add to that is, you know, you also, the get what you pay for thing really does apply here, and that if you try to go too cheap initially, you know, by definition, the corners will be cut, et cetera, and you might wind up spending more money on the back end during a review process with an SEC or an audit firm or somebody else. So kind of, you know, picking the right firm that can work with you from, you know, beginning all the way through to an IPO probably makes sense.
Yeah, let me also add that you know, in the case of a venture finance company, you're going to have board members who are VCs, and they tend to prefer, you know, people with some reputation and some establishment and some history of doing these valuations. So it's a relatively small number of my clients who really go for the, you know, sort of $2,000 to $3,000 initial cost valuation.
Yeah, and this is Ed. I would tend to agree with that discussion and the pricing, and I think one of the key things is, you know, pricing aside, you want to make sure that whoever you're using, whatever firm, that they're going to be around 2 years, 3 years from now when, let's say you are doing a public offering, that that person is around to support evaluation questions, follow-up.
Yeah, great. Thank you. Well, I know, you know, people are always interested in that and looking to know that before they get started. Another question that I see here 2 or 3 times is, I'm not sure who can answer this best, perhaps you, Dave. There seems to be some questions here about people want to know, does this apply basically to warrants that are issued to non-employees, really, not stock options, and not issued to employees, such as, you know, consultants, investors, service providers? Is this relevant?
The short answer to that is no.
Okay.
The short answer to that is no.
All right.
I would, and I agree with that, but I would warn you that from a financial reporting or accounting perspective, the accounting for those types of instruments can be particularly troublesome. So talk to an accounting advisor. And for, again, financial reporting purposes, they do need to be valued.
Right, but okay. What drives that is different types of concerns than 409A. Yeah.
Correct. Correct.
Great. Yeah, thank you. That's very helpful to everyone to appreciate that when you're going to be reporting your warrants and any expense related to them, you would need to have a fair market value, but it's not a 409A issue.
It's Channing speaking. One of the things I would just add to that is, you know, once you have an auditor and you're starting to scope out valuation work, it makes sense to bring the auditor into the discussion very early. And, you know, the auditor and valuation specialist can work on the scope together because frequently it's easier if you have other securities that needed to be valued to support financial reporting and your 409A, it's easier to kind of do it all at one time than it is to realize you missed something and have to go back and redo and edit and update and things like that.
Okay, the next question that was touched upon earlier, but I'll just repeat it in case anybody has any, or the way it was asked here, in case anyone has any further insight on this, because again, I know this comes up frequently. Does anyone have a sense, you know, and this person said, what % of companies do their valuations more frequently than annually? You know, whether it's based on, the person says, on major events or quarterly, just, you know, any of you have a way, I know you touched on this, but is there any way of responding to that question in terms of frequency?
This is Dave. In my client base, I would say that people do not do it more frequently than annually unless there's been an intervening event, typically a financing of some sort at a materially different or at a different valuation than the immediately preceding financing. So none of my venture finance clients do this more frequently than annually unless there's an intervening event that sort of presses you to do it. And as I said, that's typically a financing, but it could be reaching an important milestone. In the case of a biotech company, maybe, you know, getting positive results from some trials or something like that.
Okay, thank you. Getting into a few of the questions here that are a little bit more specific. We'll continue for a few more minutes. It is almost 3 o'clock Eastern time, so I want to wrap up shortly. But take a few questions here that are a little more, a little less broad and a little more specific to see if we can answer a couple of these. One is, and see if you can follow this question. Someone asked, how do sales by founders in connection with a VC financing affect a valuation?
So this is Dave, and this is a topic that comes up in my practice. Let me articulate the question a little better. In this sort of frothy market, particularly in the market for sort of media-type companies, it's not unusual for founders actually to get some cash in connection with a financing from a VC. And so they may be selling shares of common stock to a VC directly or indirectly. And I'm very curious to hear, how Channing, if I'm a founder of a hot new company and I take an investment from Kleiner Perkins and I say, by the way, I need $1 million to buy that, cool Tesla. And they say, okay, we'll take some of your common. How does that impact? Does it impact your valuation for the common stock?
Yeah, it's an emerging area that's coming up in more and more of our clients as they're becoming successful, and there hasn't been a lot of guidance either in the AICPA guidebook, which is in the process of being revised to include some of these issues, and it's a little bit uncharted territory, and most of our clients that have done something like this have had pretty careful collaboration among a team of advisors, including audit and tax, as well as an attorney, to structure the transaction to meet competing objectives. There can be tax implications to the founders if the, quote, fair market value of the common stock is low, and that would want them to have a higher valuation to minimize their own tax exposure. But then if you have a higher valuation, that potentially impacts the incentive plan for employees going forward. And so there's a sort of a balancing act of competing objectives many times. So that's a maybe long-winded way of saying it's a complex issue. But generally speaking, if you go back and read the definition of fair market value in the IRS term, and then you go look at the guidance about there needing to be, a consistent market with active trading volume, et cetera, a single transaction in common stock at a value that maybe is different from what the 409A value comes out to is probably acceptable. And I think you can make an argument that a single small transaction in common stock isn't necessarily, the clearing price for the whole company. But it is really situation and structure specific, and it's something that's got to be carefully thought through as part of the valuation process.
Yeah, I concur with everything you've just said. I should just add that this is exactly an area that makes lawyers incredibly nervous. And, I've certainly spent a lot of time and energy trying to structure around these issues. But if anyone in the audience were to find themselves in that situation, that they should consider it carefully and go to the advisors, because this is a place where you can get into trouble. And it could jeopardize the pricing for your entire option plan.
Two more questions. One is one I think that just asked for a little bit of tax advice that I'll just throw it out because it might be something people are generally interested in. The question is, if an employee receives a non-compliant stock option grant, should the value be included in their income in the year of the grant? And if so, how do you value it? I don't know if you can respond to that, Dave.
So if I understand the question properly, an employee gets an option grant, and the exercise price is, by admission, we'll say, below fair market value. So it's not a 409A compliant grant. And can we also assume for this purpose that the grant is vested? If the answer to that is yes, then yes, that is includable in income right away in the year in which the grant was made.
Okay. And I guess the other second half of that question, I'm just curious if anyone has any thoughts, if you can respond to it.
Maybe I missed it. What was the second half?
The second part was, how would you value that income, being that, you know, the fair market value it was granted at was admittedly, or the exercise price was admittedly below the fair market value?
Well, I would ask either Ed or Channing, but it seems to me that the income is the difference between the exercise price and the fair market value.
All right. Okay. Thank you. And then let me throw out one other question that I think will offer some thoughts for everyone in the audience. I don't know if anyone can respond to this, but I thought it was a very frank and honest question that, again, with over 100 people still on the line, there may be some of you that are like this person who says, and it sort of sets forth the background to this entire presentation, really. The person asks, we've issued options for 10 years and haven't had any fair market value valuations and have issued a large number of options at a penny exercise price. Nothing has been done regarding reportable taxable income for any of these, and a significant number have either vested or been exercised. How do I dig myself out of this hole? So I throw that question out just to say, that we're dealing with all the questions this person, all the issues this person presents in their question. I don't think it was offered as tongue-in-cheek, but just to say I'm sure our panelists have all come across many people who find themselves in that kind of a circumstance where you are have really not followed any of the requirements in all the ways that this person has presented it. So I don't know if anyone would have any thoughts to respond to that question or not.
Well, this is Dave. In the absence of anyone else diving into that morass, first of all, I should say we don't give tax advice without really being on top of the particulars, et cetera, et cetera. So this isn't tax advice for any particular situation. And I'd love to hear what Ed has to say about it as well. But, it sounds like you just are taxes owed. I mean, if people have if options have been issued in violation of 409A, and people have exercised those options or failed to declare the income, that is just a violation of the tax laws, and that tax is owed together with interest and penalties. And I'm not sure there's much you can do to go back and quote fix, close quote, that problem. I think our advice would be that this is something that needs to be fixed immediately going forward. I guess you hope and pray that you don't get audited, but that's not much of an answer.
Yeah, thank you, Dave. Anyone else have? Again, just really just responding to the question: what if you've really, as Dave said, if you really messed this up, what do you do? And at least that was Dave's response. I don't know if anyone else has any further thoughts to add, because certainly this is a case that I'm sure some percentage of people run into this problem because they just haven't followed the rules, and they're now looking forward to some event that says I ought to try to dig myself out of this hole as this person presents it.
Yeah, this is Ed. I think what you should do is try to quantify, sort of at the high level, sort of your overall exposure. I mean, you say you issued options at a penny, but if the fair value was $1.50 or something like that, it may not be a big issue. If it was $10, then maybe it is a bigger issue. But I think my best advice would be to reach out to your tax person and or your attorney and accumulate all the facts and sit down with them and spend some time going through it. And a couple of hours of time might be a good investment to make in determining whether or not you really have a significant problem or a small problem.
All right, great. For time purposes, we're going to stop now and not be able to get to all the other questions that we have received, but thank you for those questions. That ends our presentation. Let me just thank everyone for attending. I know a lot of people are still on the line, and particularly our three panelists, Dave Broadwin from Foley Hoag, Channing Hamlet from Cabrillo Advisors, and Ed Sullivan from KPMG, who each took the time today to help us all understand this complicated topic. Their contact information is in the slides, either the recorded version or the version that will be posted. But if anyone on the line would just like to get their contact information and doesn't want to look at the slides, please feel free to email us at Corporate Focus, and we'll obviously be more than happy to forward along the contact information for anyone you would like to speak with. From our perspective at Corporate Focus, if you know of anyone who's still doing their stock option tracking and reporting with spreadsheets and might be looking for a better way, of course, please let us know how we might be able to help them. And with that, again, thank you everyone for attending, and that ends our presentation.